Hello traders and welcome back to the new video of Nova Forex. So, in this video, we would talk in deep about the price action trading, and at the end, we would reveal the best price action strategy that you must know in order to make up a profitable trade into the market. Now before we commence the video, be sure to subscribe the channel and hit this bell icon to never miss out any of our new videos. Now let us first learn about the basics of the price action. The price action helps us in knowing about when the market would reverse, and also it helps us in knowing when the pullback would end. A lot of traders, including the institutional traders, use a lot of indicators to predict future price movements in order to initiate their long or short trades into the market. But a lot of indicators are lagging indicators, which creates a problem for the retail as well as the institutional traders, as these indicators predicts the future movements using the old movements of the price, which is why a lot of traders end up losing their capital into the market as the price does not move according to its previous pattern. And also, due to these lagging indicators, we would not be able to buy at the lower price as these indicators gives late entry signal. This is where the price action would help us. The price action helps us in predicting the future movements of the price in a correct way, which would help us in making huge profits into the market. Now before we move on into the video, you must know about some of the basics. The basics which you must know are breakout structure, market structure shift, multi-time frame analysis, and support and resistance zones. We would explain these basics in this video in short. And if you want to learn all these basic concepts in detail, then you can check out our old videos where we have explained these concepts in detail. Let us begin with the first concept, which is breakout structure. So, the breakout structure are of two types, which is bullish and bearish. The bullish breakout structure occurs into the market when the market breaks its recent higher high to the upside. And similarly, the bearish breakout structure occurs when the market breaks its recent lower low to the downside. When the market makes the bullish or bearish breakout structure, it indicates that the market wants to continue its bullish or bearish trend further. Now that we have learned this concept, let us move to the second concept, which is shift in market structure. The shift in market structure or change of character are also of two types, which are bullish and bearish. The bullish shift in market structure occurs when the market breaks the lower high to the upside. The bullish market structure shift simply indicates that the buyers have entered into the market and the market may reverse very soon. Similarly, the bearish market structure shift occurs into the market when the market breaks the recent higher low to the downside. The bearish market structure shift indicates that the sellers have entered into the market and the market may reverse very soon. But we cannot consider it as a reversal only by seeing the market structure shift. In order to confirm that, we need another confirmations also, which we are going to learn in this video. Now let us learn the third concept, which is multi-time frame analysis. The multi-time frame analysis is the analysis of the chart of the currency pair on different time frames like monthly, weekly, daily, and hourly. The multi-time frame analysis is done in order to know the overall trend of the market, which would help us in knowing when to buy and when to sell into the market in order to make nice profits into the market. This analysis is also done by the traders to get saved from the traps which are set by the smart money. A lot of retail as well as institutional traders use these analysis to set their buy or sell limit orders into the market, as the market respects the higher time frames point of interest more, which would help them in making up a profitable trade into the market. Now let us learn the fourth concept, which is support and resistance zones. The support and resistance zones are those zones at which there is a huge demand by the buyers and the sellers. And thus, the market moves up and down when it reaches to these support and resistance zones. The support and resistance zones is said to be valid when the market respects it for 2 times or more. These zones are also made in order to gather counter orders by the smart money. The smart money wants to buy the currency pair, but due to few sellers into the market, they couldn't do this. So, they would firstly make a resistance zone. And then when the resistance zone is respected for 2 times, the retail as well as small institutions would set their sell limit order at this resistance zone. And now that the smart money has got sellers into the market, they can easily buy the currency pair, which would help them in earning huge profits from the market. Similarly, the smart money creates the support zone into the market when they want to sell, and there are not enough buyers into the market, which is why they are not able to fulfill their sell orders into the market. And this is why you should not set your buy or sell limit orders into the market without seeing the overall trend of the market on the higher time frame. Now let us learn about the breakouts. So, a breakout simply means that the price has broken a level of either support and resistance or supply and demand or order blocks. The breakouts can also be a fake breakout, which is why it is necessary to learn the price action. The smart money sets a trap of fake breakout as they need counter orders from the market participants like retail traders and small institutions in order to fulfill their buy or sell orders into the market. Let us see an example of fake breakout. So, here we have the USD Canadian dollar chart on 1 hour time frame. We can see market making a series of higher highs and higher lows, which is why we can say that the market is going through a bullish phase currently. And then we see market going into the consolidation phase. In this consolidation phase, we see market respecting this zone for 2 times, which is why we can call this zone as a support zone. Now, by seeing this kind of move by the market, the retail traders would set their buy limit order at this support zone. Now let us see how the market reacts when it reaches to this support zone. So, as we can see here that the market went a little below from this zone. Now this move by the market would induce the breakout traders for initiating short orders. Now after that we see market going upside, which hits the stop loss of the breakout traders. So, now a question might arise into your mind that how can we be saved from getting into this fake breakout trap? So, we would analyze the candlesticks that are formed near the support zone. The market is making big bearish candles here, and then when it reached to this support zone, then also the market made this candle, which shows that the sellers have still the control of the market. And then we see market making this bullish candle with big body, which indicates that the buyers have increased into the market. By seeing this, we could not confirm that this is a reversal until the market makes one more bullish candle with big body. And as you can see that the market did this, and thus, we can take our buy position from this point, and we would keep our target at this resistance zone. Let us see one more example of this fake breakout. Here we have the USD Yen chart on 1 hour time frame. So, here we can see market making a resistance zone at this point. And thus, we would wait for the market to reach at this point for 3rd time in order to initiate our short trade into the market. The market went above this resistance zone, and thus, the traders who had placed their sell limit orders at this zone would be removed from the market. And then after that the market went to downside. Now a question might arise into your mind that why the market reversed from this point and not from this resistance zone. So, the answer to this is that the market had made a supply zone above the resistance zone, which is why the market reversed from this point and not from this resistance zone. Now let us learn about the real breakouts. Let us learn about this through example. So, here we have the gold chart on 1 hour time frame. So, here we see market making a support zone. And then the market went below this support level. And after that the market again reached at this support zone. Now there could be 2 possibilities here. The first, that the market has came at this zone for retest, or this is just a fake breakout that has occurred into the market. When the market reacts like this, then we must wait for the market to give a confirmation of real breakout before initiating buy or sell position into the market. The confirmation is necessary as this can be a fake breakout which is created in order to gather the counter orders from the market participants. So, we can confirm this of being a real breakout when the market goes below this level. And once it closes below this point, then we could initiate our short trade into the market. And the market went below, and thus, we would go short into the market from this point. Identifying these real breakouts into the chart would help you in maximizing your profits into the market. These big bearish candle which is formed here indicates that the sellers have taken the control of the market, and thus, we would initiate our trade as per the trend, which is short trade in this case. This candle shows that there is a lot of momentum into the market currently. Now that we have learnt about the breakouts, let us now move on to the strategy which would help you in making up a profitable trade into the market. So, in this strategy we would use the Fibonacci retracement along with the price action. So, let us understand this strategy with an example. So, here we have the US dollar Canadian dollar chart on 4-hour time frame. We can see market making lower highs and lower lows here. And then after this point the market started to reverse and made higher highs and higher lows. So, after seeing this first higher high we would plot the Fibonacci retracement tool in order to enter from the pullbacks to maximize our profits into the market. We can see that the market has made a pullback till this 81% fib level. But by only seeing this, we could not initiate our long position. So, to confirm that this pullback has ended, we need to wait for the market to make the rejection candles along with the bullish momentum candles. We can see this rejection candles being made followed by this bullish momentum candles. Now that the market has given us the confirmation, we would go long from this point. We would keep our risk to reward ratio at 3:1. And as you can see that we made nice profits into the market using this strategy. This brings us to the end of this video. So, in this video, we discussed the best strategy which can help you make huge profits from the market. Now before we end this video, if you found our video informative, then don't forget to like it and be sure to subscribe our channel so that you never miss out any of our upcoming videos that are being shared on the channel.